Before we begin, it's important to understand that I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only. The information provided is not, and should not be considered, financial, legal, or insurance advice. Your situation is unique, so please consult with a qualified and licensed professional before making any decisions regarding your policy. You know that feeling? That thick envelope arrives in the mail from your car insurance company. Or maybe it's a 37-page PDF that lands in your inbox with a thud. It's your policy renewal. Your declarations page. You open it, you start to read, and within seconds your eyes glaze over. It's a wall of text filled with terms like bodily injury liability, uninsured motorist, PIP, MedPay, comprehensive, collision. It's confusing. It's boring. And honestly, who has the time? So you do what most of us do. You scroll right to the bottom line, the premium, the price. You wince, you might curse under your breath, and then you file it away digitally or physically, and you pray you never ever have to look at it again. But here's the terrifying truth. That stack of paper you just ignored is one of the most important financial documents you own. And not understanding it is one of the biggest financial risks you are taking, period. It's a gamble with your house, your savings, your future earnings, everything. Because here's what the insurance industry knows, but you might not. The confusion is profitable. A confused customer is the best customer. A confused customer pays for things they don't need. And worse, they don't have the coverage they desperately do need when a crisis hits. They think they're insured, but in reality, they are one bad accident away from being functionally uninsured, left to face a financial nightmare completely on their own. Today that ends. This isn't just another boring video about insurance. This is your masterclass. This is your guide to taking back control. Over the course of this presentation, we are going to pull back the curtain and decode every single line of your car insurance policy. By the time we're done, you will be able to read this document like a pro. You will know exactly what you are paying for. You will be able to spot dangerous gaps in your coverage that could leave you exposed. And you will have the knowledge to talk to your agent with confidence, potentially saving hundreds of dollars a year while being massively better protected. We're going to turn that confusing mess of paper into your financial shield. So let's start with the most important page in that entire packet, the declarations page. Think of this as the cheat sheet for your entire policy. It's the summary, the table of contents, the highlight reel. If you only read one page, this is it. It summarizes who is covered, what cars are covered, what coverages you have, how much the insurance company will pay, and what it costs you. Let's break it down. At the very top, you'll see the basic stuff. Your name and address, the policy number, and the effective dates of the policy. Now, this might seem obvious, but it's critical. First, is your name spelled correctly? Is the address right? An error here can cause major headaches later. That policy number? Put it in your phone right now. Seriously, put it in your contacts under car insurance. When you're standing on the side of the road after an accident, shaken and stressed, the last thing you want to do is dig through a glove box or an email archive for that number. The effective dates tell you the policy period, usually 6 months or a year. This is the contract term. The price on this page is what you pay for coverage during that specific window of time. Next, you'll see named insureds. This is a huge one. This lists who is officially covered by the policy. It's usually you, and if you're married, your spouse. But what about your 16-year-old who just got their license? What about your college-age kid who occasionally drives your car when they're home for the holidays? If they aren't listed here or elsewhere on the policy as a rated driver, you could be in for a world of hurt. Some policies have what's called permissive use, which covers someone you give temporary permission to drive your car. But relying on that for household members is playing with fire. If they live with you and drive your cars, they need to be on the policy. Check this section. Now, right below that, you'll find the covered vehicles. Again, sounds simple, but mistakes happen. Is the year, make, and model correct? Most importantly, is the vehicle identification number, the VIN, correct? A single digit being off can create a nightmare scenario where the insurance company denies a claim, arguing the damaged car isn't the one listed on the policy. If you just bought a new car and traded in your old one, double-check that this page has been updated with the new vehicle. Don't just assume it happened. Verify it. You might also see a section for a lien holder or loss payee. If you have a loan or a lease on your car, this is where the bank or finance company is listed. All this means is that they have a financial interest in your car. If your car is totaled in an accident, the insurance company will typically pay the lien holder first to settle your loan, and then you get whatever, if anything, is left over. This is also why your lender requires you to carry certain types of coverage, which we'll get to in a bit. Okay, now we get to the absolute heart of the declarations page. This is the most important part. This is the section that details your coverages, limits, and premiums. This is where you see exactly what you're paying for and, more importantly, the maximum amount the insurance company will pay out for any given type of claim. This is where millions of Americans are dangerously underinsured and don't even know it. The first thing you'll likely see is liability coverage, and next to it, you'll see a set of numbers that look something like 25/50/25 or 50/100/50 or 100/300/100. What on earth does this mean? This is called a split limit, and it is the absolute foundation of your entire policy. Let's break it down into plain English. Liability coverage is the part of your insurance that pays for the damage you do to other people and their property when an accident is your fault. It does not pay for your car or your injuries. It protects you financially from being sued by the people you hit. Let's use the numbers 50/100/50 as our example. The first number, 50, stands for $50,000. This is the maximum amount your insurance company will pay for bodily injury to any one single person you injure in an accident. If you hit a car and the driver's medical bills are $30,000, you're covered. But what if their injuries are more severe? What if they need surgery, physical therapy, and miss months of work? What if their medical bills hit $80,000? Your insurance pays the first $50,000. You are personally on the hook for the other $30,000. They will sue you for it. The second number, 100, stands for $100,000. This is the maximum amount your insurance company will pay for bodily injury for all persons combined in a single accident. Let's say you hit a minivan with a family of 4 inside. One person has $40,000 in medical bills. Another has $30,000. A third has $35,000. That's a total of $105,000. Your policy has a limit of $100,000 for everyone in that accident. It pays out the $100,000 and you are now getting a bill and a lawsuit for the remaining $5,000. And that was a relatively minor accident. Imagine if the injuries were catastrophic. This limit gets exhausted frighteningly fast. The third number, the final 50, stands for $50,000. This is the maximum amount your insurance will pay for property damage you cause in an accident. This is for the other person's car, right? Yes, but not just that. Think about it. What if you swerve to miss a deer, lose control, and take out a brand new Mercedes? The average cost of a new car in America is now over $48,000. Your $50,000 limit might barely cover it. But what if you don't just hit a car? What if you hit that Mercedes and it gets pushed into a Lexus? Now you have to pay to repair 2 cars. What if you slide on ice, take out a telephone pole, a city fence, and a fancy brick mailbox? All of that is property damage. You are responsible for all of it. And that $50,000 limit that seemed okay a minute ago is now completely, totally inadequate. This is the critical mistake so many people make. They buy the state minimum liability coverage because it's the cheapest option. But state minimums in many places are shockingly low, sometimes as low as 25/50/25 or even less. That level of coverage is a financial time bomb. It's barely better than having no insurance at all. One moderate accident, one pileup on the freeway, one collision with a newer expensive vehicle, and those limits are gone in a flash. And then what happens? The other party's lawyers don't just stop. They come after you personally. They can go after your savings account, your investments. They can put a lien on your house. They can garnish your future wages for years, or even decades. Everything you've worked for can be wiped out in an instant, all because you tried to save a few dollars a month on your liability limits. We've just covered the part of your insurance that pays for damages you cause to other people. This is what protects your assets. But what about the part that protects you? What about your car? What about your own medical bills if you get hit by someone who has no insurance, or even worse, someone who has one of those cheap state minimum policies we just talked about? That's where the next sections of your policy come in, and that is where we are going next. So let's talk about that exact scenario. You're driving responsibly, you've got good insurance, you're doing everything right. Suddenly, a car runs a red light and smashes into your driver's side door. It's clearly their fault. The police show up, they write the report, and that's when you get the gut-wrenching news. The other driver has no insurance. Zero. Or maybe they have that bare-bones state minimum policy we talked about, which might only cover $25,000 in medical bills. Meanwhile, you've got a broken arm, potential internal injuries, and an ambulance ride that costs more than a round-trip ticket to Europe. Your medical bills are soaring past $50, $60, even $100,000. Who pays for that? The at-fault driver? You can sue them, sure. But let's be honest, someone driving without insurance probably doesn't have $100,000 in assets sitting around waiting for you. This is not a fantasy movie. You can't get blood from a stone. This is the exact nightmare scenario where uninsured and underinsured motorist coverage becomes the single most important line item on your policy. It is your financial bodyguard. Let's break it down. First, uninsured motorist coverage, often abbreviated as UM. This coverage steps in when the at-fault driver has no insurance at all. Think of it this way: your own insurance company essentially puts on a costume and pretends to be the insurance company that the other guy should have had. It pays for your injuries and the injuries of your passengers. There are two main flavors of this. The most important is uninsured motorist bodily injury, or UMBI. This is the one that covers your hospital stays, your surgeries, your physical therapy, and even your lost wages if you can't work because of the accident. It can also cover the unimaginable, like pain and suffering. This is the coverage that keeps a car accident from turning into a personal bankruptcy. The second, less common type, is uninsured motorist property damage, or UMPD. This, as the name implies, covers the damage to your car if an uninsured driver hits you. Now you might be thinking, doesn't my collision coverage do that? And you'd be right. UMPD often overlaps with collision, but it can be useful if you don't carry collision coverage on an older car, or if the deductible for UMPD is lower than your collision deductible. In some states, it's bundled together. In others, it's a separate choice. The key takeaway is that bodily injury is the absolute, non-negotiable part of this coverage. Now let's talk about the silent partner to this. Underinsured motorist coverage, or UIM. This is arguably even more important because it's far more common. This is for the scenario where the at-fault driver does have insurance, but their liability limits are pathetically low and don't come close to covering your expenses. Let's use a real-world example. Say you have $100,000 in medical bills from that red light accident. The at-fault driver has a state minimum policy that only covers $25,000 for bodily injury. Their insurance company will write you a check for their maximum of $25,000, and that's it. They fulfilled their legal obligation. You are still on the hook for the remaining $75,000. This is where your underinsured motorist coverage kicks in. It bridges that massive, terrifying gap between what the other driver's policy pays and what you actually owe. It pays that remaining $75,000, saving you from financial ruin. You are protecting yourself from someone else's bad decision to buy cheap, inadequate insurance. Now, I know what some of you are thinking, but I have great health insurance. Why do I need this? That is a dangerous assumption. First, your health insurance has deductibles, copays, and out-of-pocket maximums that can easily run into thousands or even tens of thousands of dollars. Your UM/UIM coverage can often cover those out-of-pocket costs. Second, and this is critical, your health insurance does not pay you for lost wages. It doesn't compensate you for the weeks or months you're unable to work and earn a living. And it certainly doesn't write you a check for the pain, the suffering, and the permanent impact an injury might have on your life. Uninsured and underinsured motorist bodily injury coverage is designed to cover all of that. It fills the gaps that health insurance was never designed to cover. So, how much do you need? And what should you look for on your policy? Grab your declarations page again. You're looking for a line that says uninsured motorist, or UM/UIM. Just like your liability coverage, you'll probably see two numbers like 50/100 or 100/300. And they mean the exact same thing, but this time they apply to you. The first number is the maximum amount your policy will pay for any single person's bodily injuries in your car. The second number is the total maximum it will pay for everyone in your car, combined, per accident. Here is the single most important rule of thumb I can give you. Your uninsured and underinsured motorist limits should, at a bare minimum, match your bodily injury liability limits. Let me repeat that. Your UM/UIM limits should match your bodily injury limits. Think about the logic here. Your bodily injury liability is the amount of protection you've chosen to provide for a complete stranger you might accidentally injure. Why on earth would you choose to protect a stranger more than you protect yourself, your spouse, or your own children? If you've decided that a person's medical bills could reasonably reach $100,000, and you've bought that much liability coverage to protect your assets, you need to assume your own bills could also reach that amount. Having less coverage for yourself than for a stranger is like buying a better security system for your neighbor's house than for your own. It makes no sense. The cost to increase your UM/UIM limits is often shockingly small, and it is the best money you will ever spend on your car insurance policy. Now, for those of you who want to go to the next level of protection, there's a keyword you need to look for on your policy documents, especially if you insure more than one car. That word is stacking. In states where it's offered, stacking is a superpower. Let's say you have 2 cars on your policy, and you've chosen UM/UIM limits of $100,000 per person. If you have non-stacked coverage, you get $100,000 of protection, period. It doesn't matter how many cars you own. But if you pay a little extra for stacked coverage, you can combine the limits from each vehicle. So with 2 cars, your $100,000 of coverage instantly becomes $200,000 of coverage for that one accident. 3 cars, it becomes $300,000. It's a way to multiply your protection for a very small additional premium. If you are in an accident, whether you're in one of your insured cars, a friend's car, or even if you're hit as a pedestrian, you have access to that much higher combined limit. Look on your policy or ask your agent if you have or can get stacked coverage. So let's pause and take stock. We've talked about your legal responsibility to pay for damage you cause to others. That's your liability coverage. And now we've covered the critical shield that protects you and your family from the financial fallout of being hit by one of the estimated 30 million uninsured or underinsured drivers on American roads. This is your UM/UIM coverage. We've protected your assets from others, and we've protected your body from others. But what about the single most expensive piece of metal you probably own that isn't your house? What about your car itself? What happens when you back into a pole in a parking garage? Or when you hit a deer on a country road, a tree slides into the road during a storm, or even a massive pothole that blows out your tire and suspension, or when a hailstorm turns your brand new hood into a golf ball? None of that is someone else's fault. So who pays then? That's where we get into the coverages that most people think of when they hear car insurance, the part that actually fixes your car. And we'll break down every dollar of it. The answer lies in 2 words you absolutely need to know: collision and comprehensive. These are the coverages that pay for damage to your vehicle. Let's start with collision. Imagine you're backing out of a tight parking spot at the grocery store. You're checking your mirrors, you're looking at your backup camera, but you misjudge the distance to that concrete pillar. Crunch. It's a sickening sound. You get out, and there's a nasty dent and a broken taillight. There's no one else around. No other car involved. It's 100% your mistake. Your liability coverage? It has nothing for you here. It's sitting on the sidelines because you didn't damage anyone else's property. This is where collision coverage becomes your hero. Collision coverage pays to repair or replace your car if it's damaged in an accident with another object, like another car, a pole, a guardrail, a fire hydrant, or if it rolls over. It doesn't matter who is at fault. If you hit someone or someone hits you, or you hit a stationary object, collision is what fixes your car. Now, this coverage comes with a critical component: the deductible. A deductible is the amount of money you have to pay out of your own pocket for a claim before your insurance company starts paying. Think of it like a copay at the doctor's office. You pay the first part, they cover the rest. Deductibles typically range from $250 to $2,000, with $500 and $1,000 being the most common. Let's go back to that parking lot pillar. Let's say the repair estimate is $2,500, and you have a $500 deductible. You would pay the body shop the first $500, and your insurance company would pay the remaining $2,000. If the damage was only $400, you wouldn't file a claim at all, because the repair cost is less than your deductible. Here's the strategic part. The higher your deductible, the lower your monthly or yearly premium will be. By choosing a $1,000 deductible instead of a $500 one, you're telling the insurance company, "I'm willing to take on a little more financial risk myself in a small accident." In return, they reward you with a lower price for the insurance itself. It's a trade-off between short-term cost and long-term risk. Okay, so collision covers, well, collisions. But what about all the other bizarre ways a car can get damaged? Remember the golf ball from the last part? What about a hailstorm that makes your car look like it has chicken pox? What about waking up to find your car was stolen overnight? Or what about the most common one? A deer deciding to play chicken with you on a dark country road. None of that is a collision in the traditional sense. That's where the second hero comes in. Comprehensive coverage. You can think of comprehensive as the life happens coverage. It's for damage to your car from events that are not a collision. It's for the weird stuff, the acts of God and pure dumb luck. This includes things like theft, vandalism, fire, hitting an animal, falling objects like a tree branch in a windstorm or that stray golf ball, floods, earthquakes, explosions, riots. Comprehensive coverage also has a deductible, which works the exact same way as the collision deductible. You can even have different deductible amounts for each. For example, you might have a $500 collision deductible and a lower $250 comprehensive deductible, because claims for things like a cracked windshield are more common. Now, a quick but very important myth buster. You've probably heard the term full coverage. You might have even told an agent, "I want full coverage." Here's the secret. Full coverage is not an actual insurance term. It doesn't exist on any policy document. It's just a common shorthand people use to describe a policy that includes the state-required liability, plus collision and comprehensive. So when you hear full coverage, just think liability, collision, and comprehensive. This brings us to the million-dollar question. Do you actually need collision and comprehensive? The answer depends on two things: your lender and the value of your car. First, your lender. While the law in most states only requires you to have liability coverage, that's not the whole story if you have a car loan or a lease. If you are financing or leasing your car, the bank or finance company that holds the title is almost certainly going to require you to carry both collision and comprehensive. Why? Because until you pay it off, the car is their asset. It's their collateral. They have a financial interest in making sure that if the car gets wrecked or stolen, there's an insurance policy to pay for it so they can get their money back. If you drop these coverages while you still have a loan, the lender can actually buy a policy for you called force-placed insurance and tack the very expensive cost onto your loan payment. But what if you own your car outright? No loan, no lease. The title is in your name, free and clear. Now the decision is entirely yours. And it comes down to a simple but sometimes tough financial calculation. You have to weigh the cost of the insurance against the value of your car. The key term here is actual cash value, or ACV. This is what your car is worth in its current state, right before the accident. It is not what you paid for it. It's not what a new one would cost. It's the market value today, taking into account its age, mileage, and overall condition. It's the number you'd see on Kelley Blue Book, or what a dealer would realistically offer you. So here's a rule of thumb many financial experts use. It's the rule of 10. Take the total annual cost of your collision and comprehensive premiums. You can find this on your declarations page. Now multiply that number by 10. If the result is more than the actual cash value of your car, it might be time to consider dropping the coverages. Let's use an example. Let's say you have an older car that's worth about $4,000. You check your policy and see that you're paying $60 a month, or $720 a year, just for collision and comprehensive. Okay, let's do the math. $720 per year times 10 equals $7,200. Is $7,200 more than the car's value of $4,000? Yes, it is. In this case, the math suggests you might be better off dropping those coverages. You could be paying a significant amount of money to protect an asset that isn't worth that much anymore. The idea is that you could instead take that $720 you save each year and put it into a dedicated savings account for a future car repair or a down payment on a new one. You'd be self-insuring. But, and this is a very important but, this is not just a math problem. It's a peace of mind problem. You have to be brutally honest with yourself. If your $4,000 car was totaled in an accident tomorrow, and you didn't have collision coverage, would you have $4,000 in cash ready to go to replace it? Or could you function without a car for a while? If the answer is no, then keeping that coverage, even if the math says otherwise, might be the right decision for you. You're not just insuring your car. You're insuring your ability to get to work, to pick up your kids, to live your life. So you've protected yourself from lawsuits if you cause an accident, and you've protected your own car from damage and theft. You're all set, right? Completely covered? Not quite. What happens when the person who smashes into your brand new car at a red light has no insurance at all, or the bare minimum policy that only covers a fraction of your medical bills? Now you're the victim, but their insurance is useless. Who pays then? That's a terrifyingly common nightmare scenario, and it's covered by two critical parts of your policy we need to talk about next. These two coverages are your personal financial bodyguards. They are uninsured motorist and underinsured motorist coverage, often abbreviated as UM and UIM, and I'm going to be blunt. If you drive in America, opting out of these is one of the biggest gambles you can possibly take. Let's start with the first one. Uninsured motorist coverage. The name says it all. This protects you when you're hit by a driver who has no insurance whatsoever. And this includes the most infuriating scenario of all, the hit and run. Imagine you're sitting at a red light, minding your own business, when bam! Someone slams into your rear bumper. You're dazed, your neck hurts, and by the time you look up, all you see are tail lights disappearing around the corner. They're gone. No license plate, no driver, no insurance information. Who pays for your car? Who pays for your trip to the emergency room, the physical therapy, the time you have to take off work? Without uninsured motorist coverage, the horrifying answer is, you do. All of it. But with UM coverage, your own insurance company steps in and acts as if they were the at-fault driver's insurance. They cover your expenses up to the limits you selected. Just like liability coverage, uninsured motorist coverage is typically broken down into two parts. First, you have uninsured motorist bodily injury, or UMBI. This is the part that takes care of you and your passengers. It pays for medical bills, lost wages if you can't work, and even pain and suffering. Look at your declarations page. You'll see those familiar split limits again, like 100-300. This means your policy will pay up to $100,000 for any single person's injuries, and up to a total of $300,000 for everyone injured in your car, combined. This coverage is your shield against a ghost. It ensures that a criminal act by another driver doesn't lead to your financial ruin. The second part is uninsured motorist property damage, or UMPD. This, as you'd guess, pays to repair or replace your car if it's damaged by an uninsured driver. Now, this is where it gets a little tricky depending on your state. In some states, UMPD is a separate line item. In others, this type of damage is covered under your collision coverage, which we'll get to in the next part. The key difference to look for is the deductible. Often, the deductible for a UMPD claim is significantly lower than your regular collision deductible. You might have a $1,000 collision deductible, but only a $250 UMPD deductible. That's a $750 difference, and it's a huge benefit when the accident wasn't even your fault. So, uninsured motorist protects you from drivers with zero insurance. But what about the problem we started with? The driver who has insurance, but it's the bare minimum, a policy so weak it's practically useless in a serious crash. That's where the second bodyguard comes in. Underinsured motorist coverage, or UIM. This is arguably even more important because it's a far more common scenario. Let's go back to that nightmare. You're in a serious accident. It was 100% the other driver's fault. Your medical bills are skyrocketing past $120,000. You've missed 2 months of work. The other driver, it turns out, was carrying their state's minimum liability coverage of just $25,000 for bodily injury. Their insurance company will write you a check for $25,000 and that's it. They have fulfilled their legal obligation. You are now left with a nearly $100,000 gap in medical bills alone, not to mention your lost income. What do? You could try to sue the driver personally, but let's be realistic. Someone carrying minimum limits insurance likely doesn't have $100,000 in assets sitting around. You can't get blood from a stone. This is the exact moment underinsured motorist bodily injury, or UIMBI, saves you. It kicks in to cover the difference. Your UMBI coverage picks up where the other driver's pathetic policy leaves off. If you have $100,000 in UMBI coverage, your policy would pay that remaining $95,000 medical gap, $120,000 total bill, minus their $25,000 payment. Suddenly, you're not facing bankruptcy. You can focus on healing instead of harassing phone calls from the hospital's billing department. Just like with there can also be underinsured motorist property damage, UIMPD, to cover the gap if their property damage liability isn't enough to fix your car. Here's the golden rule I tell everyone. Your UM/UIM limits should, at a bare minimum, be equal to your own bodily injury liability limits. Think about it. If you believe you need $100,000 of liability to protect your assets from someone you might injure, why on earth would you accept less than that to protect yourself and your family from someone else? You are insuring yourself against the irresponsibility of others. Don't shortchange yourself. Now I'm going to share a pro tip that your insurance agent might not have explained, but it can literally double or triple your protection. It's a concept called stacking. This is only available in certain states, but if you have it, you need to know about it. Stacking applies if you have more than one vehicle on your auto policy. Let's say you have 2 cars, and you chose good UM/UM limits of 100/300 on each car. Without stacking, if you get into an accident, you can only use the 100/300 limit associated with the car you were driving. That's it. It's a hard cap. But if you pay a little extra for stacked coverage, you get to combine or stack the limits from all the cars on your policy. So in that same accident, your 100/300 limit from car 1 and your 100/300 limit from car 2 are added together. Suddenly, you have $200,000 per person and $600,000 per accident in available coverage. If you have 3 cars, it would be $300,900. It's an incredibly powerful and relatively inexpensive way to create a massive financial safety net for you and your family. Pull out your declarations page right now. Look for the words stacked or non-stacked next to your UM/UIM coverage. If you have multiple cars and it says non-stacked, you need to call your agent tomorrow and ask about the cost to change it. The reason this is so critical is because the odds are not in your favor. The Insurance Research Council estimates that about 1 in every 8 drivers on the road is uninsured. 1 in 8. That means on your average commute, you will pass dozens, maybe hundreds of drivers who have no way to pay for the damage they might cause you. That doesn't even count the millions more who are dangerously underinsured. You are placing a bet every single time you get behind the wheel. UM/UIM coverage is how you rig that bet in your favor. It transforms your car insurance from something that just protects other people into something that fiercely protects you. So we've established how to protect yourself from other drivers, whether they have no insurance or not enough. But what about all the other things that can happen? What happens when you're the one at fault? Or when fault doesn't even apply? What about that patch of black ice that sends you into a guardrail? Or the hailstorm that makes your hood look like a golf ball? Or the deer that decides to leap in front of you at dusk? In all of those cases, who pays to fix your car? That's where 2 of the most essential and most expensive parts of your policy come into play. And understanding how they work is the key to not overpaying and not being caught unprotected. These 2 coverages are called collision and comprehensive, and they are all about protecting your own vehicle, your investment. Let's start with collision. The name is pretty straightforward. Collision coverage pays to repair or replace your car if it's damaged in a collision. This could be a collision with another vehicle, whether it's your fault or not. It could be a collision with an object like a fire hydrant, a telephone pole, a guardrail, or your own garage door. We've all been there. It also covers single car accidents, like if you lose control on an icy road and your car rolls over. Essentially, if your car is moving and it makes an impact with something that causes damage, collision coverage is what you'll turn to. Now, here's a critical point that trips a lot of people up. Collision coverage is for your car. It has nothing to do with the damage you might cause to someone else's car or property. That's what your property damage liability coverage is for, which we talked about earlier. This is purely about getting your own ride back on the road. And this leads to a pro tip that could save you months of headaches. Let's say someone runs a red light and plows into your car. It's clearly their fault. You have 2 options. Option 1 is to file a claim with the other driver's insurance company. You'll have to deal with their adjusters, their timelines, their rules. And if they decide to dispute fault, you could be stuck in limbo for weeks or even months with no car and no money to fix it. Or there's option 2. You file a claim under your own collision coverage. Yes, you'll have to pay your deductible upfront, but we'll get to that in a second. The huge advantage here is that your own insurance company, who you have a contract with, will start the repair process immediately. They want to get you back on the road. While your car is being fixed, they will go after the at-fault driver's insurance company to get their money back, a process called subrogation. And when they are successful, they will also refund your deductible. So you get your car fixed fast and you get your money back. Using your own collision coverage, even when you're not at fault, can be the fastest path to getting your life back to normal after an accident. Now let's talk about that word, deductible. When you look at your declarations page next to collision, you'll see a dollar amount. It's usually something like $250, $500, or $1,000. That is your deductible. It's the amount of money you have agreed to pay out of your own pocket for a repair before your insurance company pays a single dime. Think of it as your share of the risk. If you have a $500 deductible and you get into an accident that causes $4,000 worth of damage to your car, you pay the first $500. Your insurance company then picks up the remaining $3,500. If the damage is only $450, While you're on your own, the claim doesn't even reach the level of your deductible. This is where you have direct control over your premium. A higher deductible means you're taking on more personal financial risk, so the insurance company rewards you with a lower monthly or yearly premium. A lower deductible means the insurance company is on the hook for more money sooner, so they charge you a higher premium. There's no magic number here. The right deductible for you depends entirely on how much cash you could comfortably part with on a moment's notice without causing a financial crisis. Okay, so that's collision. It covers impacts. But what about all the other horrible things that can happen to a car? What if a tree branch falls on it during a storm? What if it gets stolen? What if you're driving down a country road and a deer decides to redesign your front end? None of those are technically a collision. This is where the second coverage, comprehensive, saves the day. The technical name for it is other than collision coverage, which is actually a perfect description. It covers damage to your car from almost everything except a collision. This is the coverage for the weird, the unpredictable, the acts of God. We're talking about theft, vandalism, fire, explosions, earthquakes, windstorms, hail, floods, and riots. And yes, hitting an animal, be it a deer, a dog, or a bird, falls under comprehensive, not collision. This is one of the most common points of confusion in all of car insurance. Hitting a deer is a comprehensive claim. Swerving to miss the deer and hitting a tree instead? That's a collision claim. The world is a strange place. Just like collision, comprehensive coverage also has a deductible. And here's another pro tip. Your comprehensive deductible does not have to be the same as your collision deductible. You can mix and match. Maybe you're a very careful driver and feel comfortable with a high $1,000 collision deductible to save money. But you live in an area known for hailstorms or high auto theft rates. In that case, you might choose a much lower comprehensive deductible like $250 so a non-driving event doesn't hit you as hard financially. Customizing your deductibles is a smart way to tailor your policy to your specific risks and save money. Now for the million-dollar question. Do you actually need these coverages? Unlike liability insurance, which is required by law in nearly every state, collision and comprehensive are almost always optional, with one giant exception. If you have a loan on your car or if you are leasing it, the bank or finance company that technically owns the vehicle will absolutely require you to carry both collision and comprehensive coverage, often with a maximum deductible of $500 or $1,000. Why? Because until you pay it off, it's their asset. They are protecting their investment from you wrecking it or it getting stolen. But what happens once you make that final payment and the title is in your name? The decision becomes entirely yours. This is a crossroads every car owner faces. Do you keep paying for full coverage? Or do you drop collision and comp to save a significant amount of money? There's a simple financial rule of thumb to help you decide. First, figure out the actual cash value, ACV, of your car. This isn't what you paid for it. It's what it's worth today with its age and mileage. You can get a good estimate from sites like Kelley Blue Book or Edmunds. Let's say your trusty 12-year-old car is worth about $4,000. Next, look at your insurance bill and see how much you're paying specifically for the collision and comprehensive portion per year. Let's say it's $500 a year. Now do the math. You're paying $500 a year to protect a $4,000 asset. And remember your deductible. If you have a $500 deductible, the absolute maximum your insurance company would ever pay you in a total loss situation is $3,500. Is paying $500 annually worth a potential $3,500 payout? Maybe. But what if your car is worth only $2,000, and you're still paying that $500 a year with a $500 deductible? Now you're paying a quarter of the car's value every year in premiums for a maximum possible payout of just $1,500. At this point, the math starts to suggest you might be better off self-insuring, dropping the coverage, saving that $500 a year, and putting it in a savings account for an eventual car repair or replacement. A common guideline is if the annual cost of your physical damage coverage is more than 10% of your car's cash value, it's time to seriously consider dropping it. But the final decision isn't just about math. It's about your peace of mind and your personal financial situation. Ask yourself this one simple question. If my car were totaled tomorrow, could I afford to repair or replace it without this insurance money? If the answer is a clear yes, then dropping coverage might be a smart financial move. But if losing your car would be a devastating financial blow that would prevent you from getting to work and earning a living, then keeping that coverage, even on an older car, might be the most responsible thing you can do. It's the ultimate sleep at night test. So take a look at your declarations page right now. Find that section for physical damage coverage. You'll see collision and comprehensive listed, each with its own premium and its own deductible. You now know exactly what they do, who they protect, and how to decide if the cost is still worth the benefit for your specific car and your specific life. But these aren't the only coverages that protect you and your wallet. What happens if your car breaks down on the highway? Who pays for the tow truck? And if your car is in the shop for 2 weeks after an accident, how are you supposed to get to work? Who pays for the rental car? There are special optional coverages for exactly these situations, and they are some of the best bargains in the entire insurance world, if you know which ones to pick. Let's start with the most common one, the one that can save you from a world of logistical headaches: rental reimbursement. Sounds simple, and it is. If your car is in the shop for a covered repair, this coverage pays for a rental car. But here's where 90% of people get it wrong. They see rental reimbursement on their policy, check the box, and think they're all set. They never look at the numbers. Your policy won't just say rental car covered. It will say something like $30 per day, up to a maximum of $900. And that right there is the trap. Let's go back to our story. Your car is smashed. The body shop says it's going to take 3 weeks, maybe 4, to get the parts and do the repair. That's 20 to 30 days without a vehicle. You call the rental company. You tell them your insurance will cover it. They say, great. The cheapest car we have is a compact sedan for $45 a day. Suddenly, your coverage isn't covering everything. You're on the hook for $15 a day out of your own pocket. That's $450 over 30 days that you never planned on spending, all because you didn't check the numbers. And what if you need a bigger car? What if you have kids and need an SUV or a minivan? Those can easily be $60, $70, or even $80 a day. Your $30 a day coverage suddenly feels like a coupon, not a safety net. So here's the pro tip. Before you finalize your policy, call a local rental car agency, not the airport one, a local branch, and ask them what their standard rates are for a compact, a midsize, and an SUV. Just get a ballpark figure. Then look at your policy options. If the daily rate for a basic car is $45, paying a few extra bucks per month for a $50 a day rental reimbursement limit is one of the smartest financial decisions you can make. It transforms a potential crisis into a minor inconvenience. Also, pay close attention to that maximum limit. A $900 limit at $30 per day gives you 30 days of coverage. But that same $900 limit at $50 a day only gives you 18 days. If you have a major repair, especially with today's supply chain issues, you could easily run out of coverage before your car is ready. Look for options with higher maximums like $1,200 or $1,500. The difference in your premium is often negligible, but the difference in your peace of mind is enormous. Okay, so you figured out the rental. But how did your car even get to the shop? It wasn't drivable after the accident. You were stuck on the side of the highway. This is where another small but mighty coverage comes into play: roadside assistance, sometimes called towing and labor. Almost every insurer offers this as a cheap add-on. For just a few dollars a month, you get access to a 24/7 service that can help you with a tow, a flat tire, a dead battery, or if you lock your keys in the car. It's incredibly convenient. But here's the inside scoop. You need to understand what you're buying. Is it a direct service or a reimbursement? Some policies have a dedicated network. You call the number on your insurance card, they dispatch a tow truck, and they handle the bill directly. Simple. Others are reimbursement-based. You have to find your own tow truck, pay them yourself, which could be $200 or more, and then submit the receipt to your insurance company to get your money back. That's a huge difference when you're stressed and stranded on the side of the road. You also need to compare it to standalone services like AAA. For decades, AAA was the gold standard, and in many ways it still is. The key difference is that insurance-based roadside assistance is tied to your vehicle. AAA is tied to you. So if you're in a friend's car and it breaks down, your AAA membership will help you. Your own car insurance policy won't. Furthermore, a claim under your insurance company's roadside assistance is still a claim. While most companies say these small claims won't raise your rates, they are still recorded on your claims history. Having too many of them in a short period can make you look like a higher risk. With AAA, it's just a service call. It has zero impact on your insurance. So, which is better? If you only care about your own car and want the cheapest option, the insurance add-on is fantastic. If you want more comprehensive coverage that follows you as a person and is kept separate from your insurance record, a standalone service might be the better choice. Now let's talk about the real nightmare scenario, the one that can financially ruin people. You bought a brand new car. You were so proud. You put a small down payment or maybe no down payment at all and financed the rest. 6 months later, a driver runs a red light and totals your car. It's a total loss. You're okay, thankfully, but the car is gone. You think, well, at least I have full coverage insurance. They'll pay off the car loan, right? Wrong. Absolutely devastatingly wrong. Your collision coverage pays the actual cash value of your vehicle at the time of the loss. A brand new car depreciates the second you drive it off the lot. After 6 months, that $50,000 SUV might only have an actual cash value of $42,000. But you've only made a few payments on your loan. You still owe the bank $48,000. The insurance company writes you a check for $42,000. You send it to the bank, and then you get a bill from the bank for the remaining $6,000. You are now being forced to pay $6,000 for a pile of scrap metal that you can never drive again. This is called being upside down or underwater on your loan, and it is a financial trap that has caught millions of Americans. How do you prevent this? With a simple, often misunderstood coverage called gap insurance. GAP stands for Guaranteed Asset Protection. It does exactly one thing. If your car is totaled, it pays the difference, the gap, between the insurance company's payout and the amount you still owe on your loan or lease. It turns a potential $6,000 disaster into a $0 problem. Who needs gap insurance? If you put down less than 20% on a new car, you need it. If you financed your car for 60 months or longer, you need it. If you rolled negative equity from a previous car into your current loan, you absolutely 100% need it. You can usually buy it from the car dealership, but it's often much cheaper to add it directly to your auto insurance policy. We're talking a few dollars a month to protect you from a multi-thousand-dollar liability. It is, without a doubt, one of the most crucial coverages for anyone with a new or recent model car loan. Finally, there's one more optional coverage that many people don't even know exists, but it's critical for anyone who has personalized their ride. Let's say you put on a set of expensive $2,000 custom wheels. Or you installed a $3,000 high-end audio system. Or maybe you had a custom paint job or a vehicle wrap. If your car is in an accident, your standard collision and comprehensive coverage will not pay for these items. They will pay to replace the factory wheels and the stock radio. Your thousands of dollars in upgrades, gone. That is, unless you have custom parts and equipment coverage or CPE. This is a specific add-on that lets you ensure the value of your aftermarket modifications. You declare the value of your custom parts, say $5,000, and if they're damaged in a covered loss, the insurance company will pay to repair or replace them. If you've invested money to make your car unique, you need to protect that investment. Without CPE, you're essentially letting that money evaporate in the event of an accident. These optional coverages, rental, roadside, gap, and CPE, are the finishing touches on a great policy. They are the details that separate a basic, I'm legal policy from a true financial shield that protects your lifestyle and your assets. They fill in the cracks that your standard liability and physical damage coverages leave behind. But now we have to face the scariest question of all. We've built this perfect policy. It covers your liability, it covers your own car, it even covers your rental and your custom wheels. But what happens when the person who hits you has no insurance at all? What happens when they hit your car and just drive away? You're left standing there with a wrecked car and a bill, and the person responsible is gone. Who pays then? That's where the single most important coverage for your own personal protection comes into play. Uninsured and underinsured motorist coverage. Let's break that down because those two terms sound similar, but they protect you from two very different and very common nightmares on the road. Let's start with the first one. Uninsured motorist coverage. This is your shield against the ghosts. The drivers who have absolutely zero insurance and legally shouldn't even be on the road. Remember that hit and run in the parking lot? That's a classic uninsured motorist scenario. They hit you, they vanish, and for insurance purposes, they're a ghost with no policy to claim against. Now, this coverage is typically split into two parts, and you'll see them on your declarations page. The first is uninsured motorist property damage, or UMPD. This is the part that would pay to fix your car in that hit and run. Now you might be thinking, wait a minute, didn't you say collision coverage fixes my car regardless of who is at fault? And you're absolutely right. There is an overlap here and it can be confusing. So what's the difference? It usually comes down to the deductible, In many states, the deductible for an uninsured motorist property damage claim is much lower than your standard collision deductible. Your collision might have a $1,000 deductible, but your UMPD deductible might only be $250. So, if an uninsured driver hits you and you can prove it, you save $750 out of pocket. Some people who have older cars that aren't worth much might even skip collision coverage altogether, but keep UMPD as a cheaper way to get some protection for their vehicle. However, not all states offer UMPD, and sometimes it's bundled with collision. The key takeaway is to know that it exists to help you when your car is damaged by someone with no insurance. But fixing a dented fender is one thing. Fixing a broken body, a broken life, that's something else entirely. And that brings us to the second and infinitely more important part of this coverage: uninsured motorist bodily injury, or UMBI. This isn't about your car. This is about you, your health, your ability to earn a living, your family's future. Let's leave the parking lot and imagine a different scenario. You're driving home from work, waiting at a red light, listening to the radio. The light turns green. You proceed through the intersection, and out of the corner of your eye, you see a flash of color. A car flying through their red light, texting and driving. They slam into your driver's side door. The next thing you know, you're in a hospital. You have a broken leg, 3 fractured ribs, and a serious concussion. The doctors are talking about surgery, physical therapy for months, and you being out of work for at least half a year. The medical bills start coming in. $10,000, $50,000, $100,000. And they're not stopping. Your health insurance helps, but you still have thousands in deductibles and copays. And while all this is happening, your paychecks have stopped. The mortgage is still due. The car payment is still due. The grocery bills don't care that you can't work. The police report comes back. And here's the gut punch. The driver who hit you, they were driving without a single shred of car insurance. They have no job, no assets. You can sue them, sure. But it's called suing for nothing. You can't get blood from a stone. Their liability insurance, which was supposed to pay for all of this, it doesn't exist. So who pays? Who covers your $100,000 in medical bills? Who replaces the 6 months of lost income you need to keep your family afloat? This is where uninsured motorist bodily injury coverage swoops in like a superhero. It is your insurance policy paying you because the person who hurt you can't. It steps into the shoes of the at-fault driver and pays for your medical expenses, your lost wages, and even for your pain and suffering, up to the limits you selected. Now, what if the story is slightly different? What if that driver who ran the red light wasn't a ghost? What if they had insurance, but they only had the bare minimum required by law? This is the second nightmare, and it's arguably more common. This is where underinsured motorist coverage, or UIM, comes in. Let's run that same horrible accident back. You're in the hospital, bills are piling up to $100,000. You can't work. But this time, the at-fault driver has insurance. You feel a moment of relief, until you find out they carry the state minimum liability limits. Let's say it's $25,000 for bodily injury. That's it. Their insurance company will cut you a check for $25,000, and that's the end of their legal responsibility. So you have $100,000 in medical bills and lost wages, and you've only received $25,000. You're still in a $75,000 hole. You're on the verge of financial ruin because someone else was reckless, and they were legally but irresponsibly underinsured. This is the moment your own underinsured motorist bodily injury coverage, or UIMBI, kicks in. It bridges the gap. It looks at your total damages, let's say $100,000, and it sees that the other driver only paid $25,000. Your UIM coverage then pays you the difference, up to your policy limit. If you have $100,000 in UIM coverage, it could pay you that remaining $75,000. It makes you whole. It saves your financial life. Do you see why this is so critical? Liability coverage, which we talked about before, is for everyone else. Collision and comprehensive, which we'll get to, are for your car. But uninsured and underinsured motorist coverage is for you. It's for your body, your health, your income. It's the coverage you buy hoping you never ever have to use it, but if you do, it will be the most important financial decision you've ever made. Think about this. The Insurance Research Council estimates that about 1 in 8 drivers in the United States is uninsured. That's more than 12%. In some states, it's over 20%. That means in any group of 8 cars you see on your commute today, one of them is likely a ghost, with no insurance to pay for the damage they might cause you. And that doesn't even count the millions more who only carry the bare minimum limits that wouldn't even cover a moderately serious injury. So here's the most important piece of practical advice I can give you in this entire series. Pull out your declarations page right now. Find the section for uninsured/underinsured motorist coverage. You'll see it abbreviated as UM/UIM. Look at the limits. You will likely see two numbers just like your liability coverage, for example 50/100. That would mean you have $50,000 in coverage per person, and up to $100,000 total for the entire accident. Now look at your bodily injury liability limits, the coverage that pays for others if you cause an accident. Let's say your liability limits are 100/300. You've decided you need enough coverage to protect your assets from a $100,000 lawsuit per person. Here is the million-dollar question. If you believe you need $100,000 of coverage to protect a stranger from an injury you cause, why would you only buy $50,000 of coverage to protect yourself from that exact same injury? Your uninsured and underinsured motorist limits should, at a bare minimum, be equal to your own liability limits. Let me repeat that. Your UM/UIM limits should match your liability limits. If you have 100/300 of liability, you should have 100/300 of UM/UIM. You are just as valuable as the person you might hit. Your family's financial security is just as important. Protecting yourself from the 1 in 8 drivers with no insurance, or the countless others with not enough, is not a luxury. It is a fundamental necessity. The cost to increase these limits is usually shockingly small, sometimes just a few dollars a month for an immense increase in protection. So we've covered your legal responsibility to others with liability. And now we've covered your personal protection from those same irresponsible drivers. You're protected from lawsuits, and you're protected from your own medical bills and lost wages when they're at fault. But what about your car? We touched on UMPD, but that only helps when an uninsured driver is at fault. What happens when it's your fault? Or when a tree falls on your car in a storm? Or you hit a deer on a dark road? Or you walk out of the mall to find your car stolen? In all of those cases, fault is either yours or it belongs to no one. So who pays for your car then? That requires two completely different types of coverage that are all about protecting your physical vehicle no matter what happens. These two coverages are collision and comprehensive. And if you have a car loan, I can almost guarantee you're already paying for them. But do you know what they actually do? Or how they can save you from a financial nightmare? Let's break it down, because this is where your insurance policy stops being about protecting other people and starts being about protecting you and your hard-earned money. First up, collision coverage. The name is pretty straightforward, but the implications are huge. Imagine you're pulling out of a parking spot. You're checking your mirrors, you're looking over your shoulder, but you just don't see that concrete pillar. Crunch. That sickening sound of metal bending. Your bumper is destroyed, a headlight is smashed. Your stomach drops. This was 100% your fault. We know from the last part that your liability coverage won't touch your own car. So, are you just out of luck? Do you have to drain your savings account to fix a mistake that took 2 seconds to make? If you have collision coverage, the answer is no. Collision pays to repair or replace your vehicle if it's damaged in a collision with another object. That object could be another car, a guardrail, a telephone pole, a fence, or even that pesky parking garage pillar. It also covers damage from a rollover accident. The most important thing to understand about collision coverage is this: fault does not matter. It could be your fault, the other driver's fault, or a mix of both. If your car is damaged in a crash, this is the coverage that steps in to fix it. But it's not a blank check. This is where we need to talk about one of the most important words in your entire policy: the deductible. Your collision deductible is the amount of money you have to pay out of pocket for a repair before your insurance company pays a single dime. Think of it like a copay you have at the doctor's office. You pay the first part and the insurance company handles the rest. Let's use a real-world example. Say that run-in with the pillar is going to cost $4,000 to fix. You look at your policy and you see your collision deductible is $500. Here's how it works. You pay the body shop the first $500. Your insurance company then pays the remaining $3,500. You get your car back, good as new, and you were only out your $500 deductible instead of the full $4,000. Now, you get to choose your deductible amount when you buy your policy. A common range is anywhere from $250 to $2,000. And this choice has a direct impact on your premium, the amount you pay for your insurance every month or every 6 months. It's a simple trade-off. A lower deductible means you'll pay less out of pocket if you have an accident, but you'll pay a higher premium. A higher deductible means you're taking on more risk yourself, so the insurance company rewards you with a lower premium. So which one should you choose? A good rule of thumb is to pick the highest deductible you can comfortably afford to pay at a moment's notice. If you don't have $1,000 sitting in an emergency fund, then a $1,000 deductible is probably too risky for you. On the other hand, if your car is older and only worth, say, $3,000, does it make sense to pay a higher premium for a tiny $250 deductible? Probably not. In fact, for very old cars, some people choose to drop collision coverage altogether to save money, accepting the risk that if they cause a crash, they'll have to pay for their own repairs or just buy another car. Okay, so collision covers you for crashes, but what about all the other chaos life can throw at your car? What happens when a freak hailstorm turns your car's hood into a golf ball? What about when a deer decides to leap in front of you on a dark country road? What if a heavy branch snaps off a tree during a windstorm and lands right on your roof? Or what if you walk outside one morning and your car is just gone, stolen right out of your driveway? None of those scenarios involve a collision in the traditional sense. So collision coverage won't help you. For all of that, you need its partner, comprehensive coverage. Comprehensive is sometimes called other than collision coverage, which is a perfect description. It protects your vehicle from damage caused by events that are largely out of your control. This includes theft, vandalism, fire, falling objects, storms like hail or floods, and hitting an animal. It's the coverage for the unpredictable. That deer that jumped in front of you? Even though you technically collided with it, it's considered an act of nature, so it falls under your comprehensive coverage, not collision. This is a huge benefit, because comprehensive claims are less likely to raise your rates than at-fault collision claims. Just like collision, comprehensive coverage has its own separate deductible. You choose this amount too, and it works the exact same way. Let's say that hailstorm caused $5,000 in damage, and your comprehensive deductible is $250. You pay the first $250, and your insurance covers the remaining $4,750. You might have a $500 deductible for collision and a $250 deductible for comprehensive on the same policy. They are two separate coverages that protect your car in two different ways. Now, you've probably heard the term full coverage. You might have even asked an agent for it. But here's a secret. Full coverage isn't an actual type of insurance. It doesn't exist as a line item on your policy. It's just industry slang that people use to describe a policy that includes all three of the main components we've discussed: liability, collision, and comprehensive. When you have all three, you're protected if you hurt someone else or damage their property, and you're protected if your own car is damaged in either a crash or some other chaotic event. So why are collision and comprehensive so common? Why do most people have them? One simple reason: the bank. If you have a loan or a lease on your vehicle, the lender, the bank, or finance company technically owns a piece of your car. It's their asset until you pay it off. They have a vested financial interest in making sure that asset is protected. Therefore, virtually every single auto loan or lease agreement in the country requires you to maintain both collision and comprehensive coverage for the life of the loan. They do this to protect their investment. If you get into an accident and total the car, they want to make sure an insurance company is there to pay off the remaining loan balance. If you were to drop these coverages while you still have a loan, you would be in violation of your contract, and the lender could even repossess the car. This brings us to the ultimate question. What happens when the damage is so bad that it's not worth fixing? What happens when your car is declared a total loss? This could be from a major collision or from an event like a flood. The insurance company will declare your car a total loss if the cost to repair it is more than the car's actual value. And this is where we need to understand another critical term: actual cash value, or ACV. The actual cash value is what your car was worth the instant before the accident happened. It is not what you paid for it. It's not what you think it's worth. It is a depreciated value based on its age, mileage, condition, and the selling price of similar vehicles in your local market. The insurance adjuster will look up recent sales of the same make, model, and year to determine your car's ACV. Let's say they determine your car's ACV was $15,000. Your collision deductible is $1,000. The insurance company will cut you a check for $14,000, the ACV minus your deductible. You then hand over the title, and they take possession of your totaled car. That sounds straightforward, right? You get a check for $14,000 to go buy a new car. But here's the terrifying reality for millions of Americans. What if you still owe $16,000 on your car loan? The insurance company gives you a check for $14,000. That entire amount has to go directly to the bank to pay off the loan. But it's not enough. After the insurance money is gone, you still owe the bank $2,000. So now you're in a financial nightmare. You have no car, and you're still stuck making payments on a vehicle that's sitting in a junkyard. How is that possible? And more importantly, how do you protect yourself from that exact scenario? The answer lies in one of the most misunderstood, yet critically important, add-ons you can get for your auto insurance policy, gap insurance. The name itself tells you exactly what it does. It covers the gap. What gap? The gap between what your car is actually worth, its actual cash value, and the amount you still owe on your loan or lease. Let's rewind to that nightmare scenario. You bought a brand new car for $35,000. You made a small down payment and financed $30,000. A year later, you get into a terrible accident and the car is a total loss. Your insurance company, using their formulas and market data, determines the actual cash value of your one-year-old car is now only $25,000. That's the check they cut you. But here's the problem. You've been making payments for a year, but most of that money went toward interest. You still owe your lender $27,500. So the insurance company gives you a check for $25,000. You immediately sign it over to your lender, but you still owe them another $2,500. And that's your responsibility. On top of that, you probably have a deductible, let's say another $500. So you are now out $3,000, you have no car, and you have to somehow figure out how to buy a new one while still having this debt hanging over your head. This is where gap insurance becomes your financial superhero. If you had it, after your collision coverage paid the $25,000, your gap insurance would have kicked in and paid the remaining $2,500 difference directly to your lender. It bridges that financial chasm. You would walk away from that totaled car with zero loan balance. No car, yes, but more importantly, no debt. You get a clean slate to start over. So why does this gap even exist? The reason is a brutal financial force of nature called depreciation. The moment you drive a new car off the dealer's lot, its value plummets. It's no longer a new car. It's now a used car, even if it only has 10 miles on it. A typical car can lose more than 20% of its value in the very first year. And over the first 5 years, it could lose up to 60%. Your car loan, however, doesn't depreciate. The balance goes down very slowly at first because those initial payments are heavily weighted towards paying off interest, not the principal amount you borrowed. This creates a period, often lasting for years, where you are upside down or have negative equity in your car, meaning you owe more on it than it's worth. So, who absolutely needs to consider gap insurance? First, anyone who made a small down payment or no down payment at all. A common recommendation is to put down 20% on a new car. If you put down less than that, you are almost guaranteed to be upside down for a significant amount of time. Second, if you financed your car for a long term like 60, 72, or even 84 months, the longer the loan term, the slower you build equity, and the longer that dangerous gap will exist. Third, and this is a huge one a lot of people fall into, if you rolled negative equity from a previous car loan into your new one. Let's say you owed $3,000 more on your trade-in than it was worth. The dealer kindly says, "No problem, we'll just add that to your new loan." You just started your new car loan $3,000 deeper in the hole. You need gap insurance, period. And finally, if you drive a lot of miles each year, high mileage accelerates depreciation, widening that gap even faster. Or if you bought a vehicle that's known to depreciate quickly, like some luxury sedans or certain types of electric vehicles. Now, where do you get it? The most common place people are offered gap insurance is at the car dealership, during the financing process. And you should be very, very careful here. Dealerships often mark up the price of gap insurance significantly. They might charge you $700, $800, even $1,000 for it. And worse, they often roll that cost into your car loan. That means you're not just paying a high price for the coverage, you're paying interest on that high price for the entire life of your loan. A $700 policy could end up costing you over $1,000 by the time you're done. The best kept secret is that you can almost always buy gap insurance directly from your own auto insurance company. And it is almost always dramatically cheaper. We're talking about adding it to your policy for maybe $5 or $6 a month. That's $60 or $70 a year. A tiny fraction of what the dealership charges. So a pro tip: when you're buying a car and the finance manager offers you gap insurance, politely decline and tell them you'll be adding it through your own insurance carrier. Then call your agent or go online that very day and add it to your policy. So, do you need it forever? Absolutely not. Gap insurance is not a lifelong commitment. You only need it as long as the gap exists. Once you reach a point where your car's value is equal to or greater than your remaining loan balance, you can cancel it and save the money. How do you know when you've reached that point? It's simple. Once a year, check your car's current market value on a site like Kelley Blue Book or Edmunds. Then, look at your most recent loan statement to see your remaining principal balance. The day that Kelley Blue Book value is higher than your loan balance, you can make the call to your insurance company and drop the coverage. Now, there's another type of coverage that often gets confused with gap insurance, but it serves a very different purpose. It's called new car replacement coverage. While gap insurance is designed to protect your lender, new car replacement is designed to protect you. If your new car is totaled in a covered accident, this coverage doesn't just pay you the depreciated actual cash value. It pays you enough money to buy a brand new car of the same make and model. Let's see how that's different. Imagine you total your one-year-old car. The actual cash value is $25,000, but a brand new replacement model costs $32,000. With standard collision coverage, you get a check for $25,000. With new car replacement coverage, you get a check for $32,000. It completely ignores depreciation and makes you whole in the truest sense of the word. It puts you back into the driver's seat of a brand new vehicle. The eligibility for this coverage is usually very strict. It's typically only available for brand new cars. You must be the original owner, and you often have to purchase the coverage within the first few months or a year of owning the vehicle. The coverage itself might only last for the first 2 or 3 years of the car's life. So which one is better, gap or new car replacement? They solve two different problems. Gap insurance pays off your loan so you're not left with debt. New car replacement gives you the money to buy an identical new car. In a perfect world, if you qualify, having both offers the ultimate protection. But if you have to choose, think about your primary concern. Is it getting out of a loan you're upside down on? That's gap insurance. Is it ensuring you can get back into a new car without shelling out thousands more from your own pocket? That's new car replacement. The key takeaway is that your standard policy is designed to pay what your car is worth today, not what you paid for it, and not what you owe on it. Understanding these optional coverages is the only way to protect yourself from that harsh reality. We've dissected the declarations page, we've unraveled every type of coverage, we've explored the fine print of endorsements and add-ons. But we have saved the most critical part for last. What do you actually do when the worst happens? How do you file a claim, deal with an adjuster, and fight to make sure you get every single penny you are entitled to under your policy? That's the final piece of the puzzle, and it's what we're breaking down next. The moment of an accident is pure chaos. Your heart is pounding, adrenaline is coursing through your veins, and it's easy to forget everything. But what you do in those first 30 minutes can determine the outcome of your entire claim. First, before anything else, assess for injuries. Yourself, your passengers, the people in the other vehicle. If anyone is hurt, your first and only job is to call 911. Nothing is more important than health and safety. If the cars are in a dangerous spot like the middle of a highway, and they are drivable, move them to the shoulder. Turn on your hazard lights. Your safety is paramount. Once you've confirmed everyone is safe and 911 has been called, you become an evidence collector. Do not, under any circumstances, apologize or say, "It was my fault." Adrenaline makes us say strange things, but an apology can be twisted into an admission of guilt later. Stick to the facts. Exchange information with the other driver. You need their full name, address, phone number, their insurance company name, and their policy number. Give them the same information. Take a picture of their driver's license and their insurance card. It's faster and more accurate than writing it down. Now, turn your phone into your most powerful tool. Take pictures of everything. And I don't mean 2 or 3. I mean 50. Take wide shots of the entire scene, showing the position of the cars, the street signs, the traffic lights. Take medium shots of the damage on both vehicles from multiple angles. Then get close-ups. Document every single scratch, dent, and crack. Photograph the other car's license plate. Photograph the road conditions. Are they wet? Are there skid marks? This collection of photos is your objective, undeniable proof of what happened. It is your power in the negotiation to come. When the police arrive, cooperate fully. Give them a clear, factual account of what happened. Avoid emotional language or speculation. Just the facts. I was traveling north in the right lane. The light was green. The other vehicle turned left in front of me. Get the police officer's name. badge number, and the police report number. This report is a crucial, official third-party account of the incident. Once you are away from the scene and have taken a moment to breathe, it's time to notify your insurance company. Call the claims number on your insurance card or use their mobile app. Do this as soon as possible, even if you think the other driver was at fault. Why? Because your policy is a contract that requires you to promptly report any potential claim. More importantly, by reporting it to your company, you get your own team on the case immediately. If you wait for the other person's insurance to contact you, you're already on the back foot, playing defense. During that first call, have your policy number, the police report number, and all the information you gathered at the scene ready. The person you speak to will open the claim and assign it to an adjuster. From this point on, every conversation matters. Soon after, you'll be contacted by an insurance adjuster. It might be an adjuster from your company, or if the other driver was at fault, from their company. And this is the most critical thing to understand. The adjuster is not your friend. They are not your advocate. Their job, their primary performance metric, is to resolve the claim for the lowest possible cost to their employer, the insurance company. They are the gatekeeper to the money. They'll likely ask you for a recorded statement. Be incredibly cautious here. Their questions are expertly crafted to get you to say something that could minimize their liability. They might ask, "So you were a little distracted right before the impact?" Or, "You didn't see the other car until the last second?" These are traps. You are not obligated to give a recorded statement to the other driver's insurance company. If it's your own company, you may be required to buy your policy, but you can still be careful. Stick to the absolute verifiable facts you documented. If you are injured in any way, it is highly advisable to consult with an attorney before ever giving a recorded statement to anyone. Next comes the vehicle inspection. The adjuster will want to look at your car to assess the damage. You have the right to have it inspected at the body shop of your choice. Do not let them steer you to their preferred shop if you aren't comfortable with it. Get your own independent estimate from a shop you trust. This gives you a baseline. If the cost to repair your vehicle is less than a certain percentage of its value, usually around 70 to 80%, the insurance company will agree to pay for repairs. If the cost exceeds that threshold, they will declare the car a total loss. This is where the real negotiation begins. If your car is totaled, the insurer is required to pay you its actual cash value, or ACV. This is the amount your car was worth 1 second before the crash. Their first offer for the ACV will almost certainly be low. They will produce a report using a third-party vendor that shows comparable vehicles, but these comps are often from distant areas, or are in worse condition than your car was. Do not accept the first offer. This is where your own research is your leverage. Go online to auto sales websites. Find at least 5 examples of your exact year, make and model of car, with similar mileage and options, for sale within a 100-mile radius of your home. Screenshot these listings. This is your counter evidence. Send these to the adjuster with a polite but firm letter or email, stating that their offer is insufficient based on the local market value, and present your figure based on the average of the cars you found. This is how you fight for the true value of your vehicle. And here's a pro tip most people don't know about: diminished value. Even if your car is perfectly repaired, its resale value has taken a hit because it now has an accident history. In many states, you are entitled to file a claim against the at-fault driver's insurance for this loss in value. It's called a diminished value claim. The insurance company will not volunteer this information. You have to demand it. You may need to hire an independent appraiser to document the diminished value, but it can often add thousands of dollars to your settlement. Whether you're settling a repair, a total loss, or a diminished value claim, you will eventually reach a settlement figure. Before they send you a check, they will send you a document called a release of all claims. Read this document with extreme care. By signing it, you are agreeing that this payment is the final, complete settlement for this incident. You are releasing the insurance company and the other driver from any and all future liability. If you later discover your neck injury is more serious than you thought, or the mechanic finds hidden frame damage, it's too late. You cannot go back and ask for more money. Do not sign that release until you are 100% satisfied that the settlement covers all your damages, both present and future. And what if you reach a dead end? What if the adjuster is unreasonable and won't budge? You have options. You can ask to speak to their supervisor. You can file a formal complaint with your state's Department of Insurance, which regulates the industry. And for significant disputes, especially those involving serious injuries, you can and should consult with a personal injury attorney. Over these last 10 parts, we've journeyed from the simple numbers on your declarations page all the way to the complex, high-stakes process of a claim. We've demystified the jargon, decoded the fine print, and pulled back the curtain on how this industry really works. Your car insurance policy is not just a bill you have to pay. It's not just a piece of paper you stick in your glove box and forget. It is a powerful financial tool. It's a shield designed to protect you, your family, and your future from financial ruin. But like any tool, it's only effective if you know how to use it. And now you do. You know how to read the manual. You know how to spot the gaps in your armor and how to fortify them. You know how to shop smart, ask the right questions, and demand the value you deserve. You understand that the lowest premium isn't always the best deal, and that the right coverage is priceless when you need it most. And you know how to stand your ground and fight for every penny you are owed when the worst happens. This knowledge is power, puts you in control. So I'll leave you with one final task. Go find your policy documents, open them up, and read them not with confusion or dread, but with confidence. You are no longer just a policyholder. You are an informed, empowered consumer, fully in the driver's seat of your own protection.